Bill. Welcome, mate. Welcome, crew. Thanks for joining us for today's cap table mastery. We're going to focus today more so on cap table modeling, but we'll do a little bit of the basics as well. I'm Jason. I presume most of you know me, and thankfully today I have the legend Dave Kenny with me. We've done this session something very, very similar before. It was very, very popular. So thanks, Dave, for coming back again to do this one.
Pleasure, mate.
While people are coming in, yeah, so just today's session is co-run between Cake. Cake's a cap table solution. So for all of you startup founders out there or anyone managing cap tables, do check it out. And Dave Kenny, when we first met, besides being, like a startup investor and advisor, you were at Hall Chadwick for quite a long time, but there's been a big shift. Tell us about Start Growth while people are joining.
Yeah, look, left Hall Chadwick 2 years ago and set up a company called Start Growth, which is all about helping founders grow. And I've got a bunch of people, experts in different areas of the startup journey who are consulting to build companies and unlock doors and open windows and be there in the camp and boots on the ground, expertise with sales, marketing, strategy, and capital raising and financial modeling, all that sort of stuff. And yeah, having fun. And that's a bit about Start Growth, but I can't believe it's a very different world to the one I was in. But it's, yeah, no regrets, having lots of fun.
Now, it's great to see the new business flourishing, and you founded a couple of businesses as well. So yeah, excited to work with you. For those of you that don't know, I'm one of the experts at Start Growth as well. So I'm really happy to be able to share some of my expertise with the Start Growth crew. But so today we're here to talk about cap table modeling. So between us, Dave and I have seen a lot of cap tables, helped a lot of companies raise capital. Mostly myself, I've helped Cake, go through a bunch of rounds, and we've learned a lot through that. And I've been mentoring. So what, through Cake becoming, a leader in the cap table space, we've been collating, I guess, the best information around cap tables and cap table modeling and learning from the best people in the industry so that we can then help you get access to the best information, minimize the mistakes and hack through and just kind of know best practices as quickly as possible. Obviously, David was one of my mentors throughout that time. He's mentored a ton of companies, and so I'm grateful to be running this together with Dave. We'll be just bouncing off most of the slides a little bit together. It's going to be somewhat informal. We're going to utilize some pretty basic cap table slides to then try and wrap around that deeper understanding and that real IP and that real world knowledge that we have, to help you get the best outcome. Anything
It's
you
not,
want
a- it's not,
to?
it's not a school class. We're going to be telling people where the bodies are buried, what to look out for. There's no point in doing a detailed dive on a specific set of circumstances because they probably don't apply to you. But instead, what we'll do is we're going to say, here's what we're looking at when we're either raising money, spending it, hiring staff, and all of those things are related to capital allocation. So if you can do that well, you're going to get through it and allocate it well, raise it well, spend it well. That's what we're here to talk about today.
Thanks, Dave. So we'll keep it to about 30, 40 minutes because I know we're probably all on our lunch breaks or similar, and we've got a lot to do. For those of you that want to stick around and have questions, let's absolutely do that, towards the end. If you want to put the questions in as we go, though, we will attempt to tackle the questions on the fly because I think that they can actually add richness to the discussion. We can go backwards and forwards a little bit as we go. I've got the webinar chat open, so just throw questions in. We've also got my teammate Cal here in the background, so if Cal sees cool questions that we miss, I'm sure he'll be able to help us out there. So. Let's jump into it. So we're going to talk a bit about what is cap table modeling and what is a cap table a little bit just to kick us off. We're going to try and talk through goals and mistakes and things like that. So like some really practical stuff. We're going to we're going to go through some examples as well because actually going through examples will give us an opportunity to, look for some insights to share. So getting right into it, the absolute basics. What is a cap table? First of all, I wouldn't normally have it in two words like that, but who cares? So it's a detailed ledger. I suppose one thing I wanted to say is we are going to do the basics, but if you have more complex questions, do ask. This is sort of a pre-seed to Series A sort of framework, so we're happy to cover later stage issues if you have them. But we'll do a little bit of basics as well. We'll try and rip through the basics quite quickly. So yeah, like your cap table is another word for equity. So it can be everything, including shares, ordinary or preference shares, convertible notes, safes, warrants, options, all that stuff. Essentially, I want you to think about it like a huge long list of everyone who owns any type of equity, and then just how many do they own? So what do they own, and how many do they own, and then what percentage is it? I mean, that's the absolute basics of a cap table. And we're trying to work out what that's worth as well, right? So, hey, like if you own 10% of a $10 million company, great, you've got $1 million worth of equity. So that's kind of the real basics.
Just to like truck in there, Jace, I think the big mistake a lot of founders make is they think that this is like a job for either the accountants or the lawyers to do. And this is really where you're looking at, how much money you're going to raise, what you're going to spend it on, where your dilution is going to rise, and think about, have I got enough money to get to that next level? This is something you've got to become intimate with, not in terms of the law necessarily, but what's going to happen on this journey, and how many swings at the plate are you going to get to create some value for customers and create some value for your company. So you've got to start getting intimate with where this is going to go, because you can soon find yourself out of a job possibly if you're not potentially in control anymore with dilution, but also gets you to think a bit more deeply about your forecasts and understanding that, yeah, they're guesses, but you've got to have a goal and have something to aim at. So without that modeling exercise, you are really swinging in the dark.
Yeah, it should be. The management of your cap table needs to be an absolute top priority for founders. It's right up there with, with the most important things. So how is it used? So, a little bit of a boring and basics thing. So you need your cap table to just do your tax and regulatory stuff. Um, like David was saying, this is the really important stuff. You need your cap table to raise funds and manage investment. So it's super critical for that. And then to see the impact of funding decisions. A couple of examples here, Dave, on how we're using our cap table in practical terms. So we want to avoid this. Does anyone, we don't want disputes, right? We don't want one person ending up with everything. We don't want, another person screwed out of what they've earned. We don't want ambiguity in the legal contracts. We want to have a fair and transparent ownership structure. We want all the stakeholders to be, valued and coming on the journey. We don't want to end up in court. We don't want to end up with a movie after us, all these things. And like there are a lot of like pretty crazy outcomes if you get it wrong. But it's also, somewhat straightforward to manage if you follow best practices.
And you're spending people's money, your time, other people's time, and other people's money. So if I defy most people who can actually work this through a model at over 3 or 4 levels without actually using a tool, and Kate can do that. So it's you've got people sitting there, being, earning options, and if they're not doing a good job, you're getting diluted.
So let's talk about some goals. What are we actually trying to do here with our cap table? So these are some points that I put down, Dave. I'm happy for you to elaborate as well, of course. So, as a founder, what you're trying to do is retain maximum ownership. Obviously, this is within reason. If you don't have a balanced approach, you're not going to get a great outcome. But bearing in mind, investors have an unfair advantage against you, especially if you're a first-time founder. But even if you're a second or third-time founder, when you do your first round, you've done one round. Your investor might have done 100. When you do your second round, you've done two rounds. They might have done 100. So I believe there is information asymmetry. So you need to bear that in mind. And I'm not saying that to be, overly argumentative against investors, but just bearing in mind, you need to have a goal of making sure that you can retain maximum ownership down the track. And it's not just for you, it's for, that early team as well. Those key early investors and supporters and team members. You want to make sure that they get a good fair outcome in the medium term. So having that in mind helps you,
Yeah, and
make the
being
right.
able to offer the right type of participation to people, working out how you're going to see the dilution impact on both capital, but also the right type of people and how much they should get in equity. Those sorts of things really are done, well or poorly, and investors are probably going to be happy to get better deals at the start. But if you can't work out how to run this capital, you are definitely going to get a worse deal even if you grow. So there's the difference between doing this well and poorly is millions of dollars.
Oh, absolutely. So this is, the second point there, managing well to maximize investor value. So let's think about how you could manage your cap table well. Um, so valuation. So you're raising, say, a seed round, and based on the metrics, your company could be valued anywhere between 5 and 10 million. And I honestly believe that the same company could receive a $5 million pre-money val or an $8 or $10 million pre-money val based on the performance of the founder. And so just bearing that in mind and understanding how to put your best foot forward, how to prepare very well, and how to articulate and go into a capital raise in the strongest possible light to achieve, the best possible valuation is a way that you can manage your cap table well. And you might think, well, how's that managing my cap table? But it's because the dilution that you're going to get on a 5 million versus a 10 million could be significantly different. If you raise 1 million on 5 million pre, well, let's do 4 million pre, so that's a 20% dilution versus 10% dilution at around 10 million. Now, of course, you've got to bear in mind. Now I'm getting a bit complicated early in the discussion, Dave, but let's quickly talk about overvaluing your company as well. So what happens if you say, hey, I'm going to go for that $10 million val, but then you never grow into that val. It takes you 3 or 4 or 5 years to really, really be worth that. And then you have to have down rounds, or we might raise on a safe, and then you don't hit the valuation cap, and you go out and you really crush your cap table by having significant over dilution. So I've covered quite a few topics there, and for those of you that are newer to this, you might have to ask questions. But the point there to make is how you value the company, how high or low it is, and the type of equity that you use when you're raising. These are major, major variables in how much you own of your company when you fast forward 3 or 5 years down the track.
If you're using all of the tools correctly, including your cap table, explaining the logic of why you are raising money at $10 million, even though you might be doing a push-pull exercise in terms of the early raise process with VCs to sort of find where they feel that the valuation inflection points are between a hell yes and a no. Given that it's not the only metric that you should be looking at the valuation, it's a chance to actually have early conversations and test that process, and that is managing your cap table. Those early discussions to find where that value point is and how to actually articulate what your value is. This is part of cap table management and mastery.
Absolutely. The next reason why you want to have a really good quality cap table is that your investors will trust you more. So if you provide a cap table summary that's amateurish and or broken, and the spreadsheet doesn't match the documents, doesn't match ASIC, you're going to erode trust with your investors. If you go out for, trying to raise the wrong amount on the wrong pre-money valuation, and all those things I talked about, if it doesn't make sense and you can't clearly articulate that, and you don't have strength and knowledge in your cap table and your cap table model, it's a red flag for investors. It's one of the biggest red flags because they're giving you money which goes in your cap table. So it's very important to have a, just great strategy, the right advisors, a really good understanding of it, and very, very good documentation, because when they look at that, that builds trust, and it's more likely that they're going to give you money at the valuation you want.
Think of it this way: you've got your shit together, or you don't. You can't organise some of these things using really good tools that are available. You're really not going to
Mm.
be let loose with, hiring lots of people and spending lots of money.
Only the best succeed, right? A This is not like a playground. This is a sink or swim space that we're in. You have to be awesome at this stuff, like you have to be awesome at nearly everything. Otherwise, you're just not going to succeed. And then one thing I'll add is just having the right advisors, having the right accounting, tax, legal advisors that are very experienced at this stuff, that are used to going through angel rounds, that are used to going through VC rounds, that can give you the right types of advice. If you've got the wrong types of advisors that are going to give you maybe old school advice, maybe traditional business advice, or just not know the right best practices, that's actually going to really work against you. You'll probably go out with the wrong data in the first place. And then when you start negotiating, it's going to be really frustrating. So yeah, just make sure you've got the right team that have got the right
Yeah, and
experience.
also just on that, I've seen some lawyers and accountants that are very friendly to the VCs. So I understand that. I remember doing a discussion with you, Jace, a number of years ago, and also with Quentin Wallace from Archangel, and we had a joke about safe notes and thought, how safe are safe notes? The
Yeah.
difference between a good safe note and a founder-friendly one is like the size of the Sydney Harbour.
Yeah.
So
And
those guys,
we did say we were gonna throw a bomb or two here. And while I love Airtree and all their documentation and their service to the community, the Airtree open source term sheet is a bit investor friendly, in my opinion. And you could argue that, that there's some things in there that you could soften. I wasn't able to negotiate much extra softening in that in my seed round, but you may be able to. Um, our most recent round that was led by Jason Calacanis, for example, doesn't have founder vesting in it. And, so there are some things in that term sheet that are arguably a little bit investor friendly, but it's a very good starting point. And then the last thing I like to say with cap table goals is, because I'm from Cake and we really believe that your equity is a great driver of value in building a great team. So just make sure that when you've got an ESOP in place and your team have equity, that they believe in that equity as well as a driver of value for your company.
yeah, and just the last point on that ESOP as well, Jace, is working out when to issue ESOP, how much to issue, because usually you're paying for it, so it's coming out of the founder's hide in terms of how it's allocated. So being in touch with what your team is going to look like, how they're going to build, being able to explain equity rather than in percentage terms, like saying, well, I've got 1% of a bloody apple, for example. That doesn't
Mm.
sound much. So getting really familiar with the language and being able to talk about the future without necessarily breaching forward rules and ASIC rules, etc. But you've got to get familiar with this, and it is mastery to be able to explain this in terms that people get, in simple terms that meaning that you need to go. They'll go and ask their lawyers, and they'll find a lawyer saying, "Well, show me the balance sheet before you start working for this company."
Yeah, 100%. When you've got a $5 million company, you're raising it 5 million with a 10% ESOP. That's $500,000 worth of your company that you're, starting to allocate. And then you've got a 10, 20, $50 million company. The dollar value of the equity that's with your team is huge. So you have to make sure you're getting value back in return for that. So now I've got a little worked example about, let's say an arbitrary but, aspirational goal for founders. I don't know where you would put it, Dave, but I think, if we can see founding teams having more than half their company at Series A, I think it's a great goal. We definitely see that happening in some circumstances, but we also see it not happening in many circumstances. And I just wanted to talk through a little bit about how that can occur and what the big variables are, or some of the big variables. And Dave, let us know what you think as well. But so first of all, it's not easy to achieve this goal because innovation costs money. Teams cost money, innovation costs money. Quite often, things take twice as long and cost twice as much as you think. And you're diluting yourself constantly all the way while you're trying to get to that Series A round. Series A rounds are harder to get to than ever before. Like a Series A in the US is like 3 to 5 million US ARR. It used to be kind of you hit a million ARR Aussie dollars and you raise a Series A, and in some niches, that's still the case. But look, it's hard to get there, and I just wanted to talk through like what happens if you just do too many rounds, like or not too many rounds, but let's say more rounds than you otherwise could, and at least if you're aware, you can try and avoid them. So first of all, each round, pre-seed, seed, whatever, seed two, which is quite common. Each round you normally dilute about 20%. It can be 10 to 20% depending on what the round is. Pre-seed sometimes 10%, sometimes a bridge. Between seed and Series A could be 10%, but each round is 10 to 20% dilution normally. Your ESOP as well is 10 to 20%. So, thinking through how much capital you're going to need to get from zero to Series A is a really smart thing to think. And then if you need that much capital, how is that going to impact your cap table? How much dilution are you going to want to accept? And then building a model, say, over a 3 to 5 year period to try and mitigate the need for extra rounds, which are quite common. Because, here's an example. You start off with 100%, the founders, you add your ESOP. So let's say that takes you back to 85. And then you run your pre-seed, and then you run your seed, and then you run your Series A. So in this really solid situation, you've got about 48%. So that's just getting through the normal rounds and having your ESOP in place. Um, so, but what happens if you have to raise a seed too, or even or a pre-series A or whatever? So then you're down around 40%. So I just wanted to use this example to help you understand if you could bootstrap, skip pre-seed, and just raise seed and Series A, for example, you're going to end up with more than 50%.
Yeah, I would
Um,
add to that, Jace, that I think that the problem with approaching um, raising money from formulas and what other people did fails, to trigger your own negotiation skills and say, "Oh, I'm supposed to give up 20%. I'm supposed to raise whatever I do and do that." So that you will do a better job if you can tell your story better. You have a financial model that might look at even 10 years. You're modeling, you're chasing a specific company. You're trying to look forward and back to bridge that gap. And what you're trying to do is anchor and build that credibility that you're good at making bets and sufficient bets in the right things. So the there are no formulas for this. There is just how good are you? Who do you meet? How well do you tell your story? And remember, these things can be buried in the detail. You can have. I've seen some term sheets that have been looking reasonably good on face value, and then having side letters and saying the side letter might say, I want you to have a 30%. I've seen 30% option pools. I've seen by the time you've got founder revesting, option pools coming that are quite frankly overly generous or overly dilutionary, and then also having first right of refusals and most favored nations, and having too high a point for when the financing round is deemed to have occurred. So stacking post money safes on top of post money safes. It's a very investor friendly process, which almost seems like it's become standard to do post money safes. But again, assuming that anything is standard, I think is the first mistake. You want to get the best people that are going to add value and believe in your vision and want to keep backing you to get there. Because if you're constantly managing this with the wrong people, you are going to be that footnote where you do get unnecessarily or diluted without having any real value added. So those things do come up and bite you, and those terms are very complicated often, and the more complex it is, the more likely it is it's going to be against you anyway. So there's a my view is like, let's see how you go. Let's don't use formulas to raise money. Use your brain. I'm not being rude. I'm just saying that if you build up a real trusting relationship, and you do, as Jason said, do some bootstrapping initially, and say, I'm going to be doing this, but I'm not raising money. That proof that you did that in the subsequent meeting is a hell of a lot, more intelligent than, just arguing with the founders to say, arguing with investors to say, oh, I'm only going to take your money if I'm at a $10 million valuation. Prove that you do, and that all of a sudden becomes a whole lot more of an easy conversation to maintain the valuation and negotiate much better terms, both from a cap and a collar, or even governance terms. And there's a whole bunch of governance terms in the document about how fast you go, how much you report, how much you do, etc. And those are the types of things that I think we should be thinking about. And yeah, this is why this session was called Mastery.
No, very, very good insights. And one thing I've taken from that, Dave, is just, I suppose, raising from a position of strength, controlling your business, building a real business, and not just, raising for the sake of raising, not raising when you're really desperate, and building a real company that's as sustainable as possible, and utilizing capital to, for specific tasks, whether it be product or go to market, and being very clear about what they're for. Yeah, that's really going to help. We've got a question come through from Tristan, just to touch on the topic of raising at too high a valuation. So yeah, from my perspective, and this happened a lot during the frothy times of 2020 and 2021, where so when you raise at too high valuation, so just say for argument's sake, business is turning over 2 million. Well, actually, a little bit earlier in the journey here. So just say you raise a seed round and you're in AI and you get a $25 million pre-money val and you're raising 5 million. But you've got very little revenue. You might have almost no revenue, or some revenue, but you're still a very early stage company. At some point down the track, you're going to have real business metrics that match that valuation. So we're talking, revenue growth, profit, market share, strong unit economics. So you'll have to go from having, an idea or whatever you've got, a very early stage business, to having a very successful, solid business, with team and go to market and brand and unit economics and finance, legals and IP and everything, right? So you've got to make this huge jump from zero to hero, with having this huge valuation already established. And the risk is that you never make that jump. So it is really an all or nothing play. Now, it's not to say that some of you can't do that, and some of you shouldn't. All of you shouldn't do that. The vast majority of us should not do that. And very few people that do that succeed, but that does happen. And full credit to those businesses that can. There's one in whatever 1,000, 10,000 businesses that just go bam, 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 and just go all the way, with full velocity. But you just need to be aware that maximum velocity business is extremely rare, and just be aware that if that's not you, what's the downside risk? Dave, you want to elaborate
Yeah,
on that? I'll talk a
absolutely.
little bit about the
I hope he
downside
doesn't.
risk.
I hope he doesn't mind me talking out of turn, but I mean, Alistair Faulkner is a founder that said, look, all this rubbish, 5, 10, $20 million valuations, not for me. Admittedly, a second-time founder, from Threat Metrics, and he had people frothing to invest, and at very large valuations initially. But it's a question of, can you get that shit done? And thinking about the modeling aspect again is, if you're starting with a pre-money or post-money, whatever, we'll get to that later, of $25 million in your example, Jace, the question I'm asking is, can you justify a $50 million valuation in, say, 18 months? What does a $50 million business do? What's the runway going to look like to get there? What's my burn going to be? What am I going to do with the team? What am I going to need to deliver? What are my metrics going to be? And does it actually make sense? Do I have the people to deliver on that? So if you can say yes to those, then you'll have way less drama and having going in with a standard. Well, most Y Combinator startups value at this or whatever, and that's the top echelon. You decide how good you are, but that should come back to how good your team is, and a lot of time that comes back to thinking about, do I scrimp and save and try and do something on a minor, like a bunch of people that are newbies, or how do I get my balance right between, people that are going to be right for the next first part of the journey or the second part of the journey. You're playing human Tetris in this game. It's a what you're probably hiring for skills um, or you're looking for skills, but you're hiring for fit, and being able to work out, will people bootstrap? Are they the right people? You might learn that you shouldn't be bootstrapping. This ain't a thing yet, or it's not. This is a constant iteration of having enough courage, but also having enough emotional intelligence to say, am I believing my own bullshit here? So it's a question of getting all of those questions right. And if you're good enough to raise at $25 million plus, like a number of founders that I've worked with are, and that's probably because you've worked through some of these issues and you've got a compelling and logical process around why you're the one to do that and deliver. And you're not going to be burnt by down rounds and ratchet clauses and liquidation preferences and all those sorts of things that will be slotted in to catch you out, and first right of refusals, and
Well, let's talk about that.
the
When you
hundreds of
some of
the people have come up with to screw the founder.
Yeah.
That
Let's talk a bit about that, Dave. Like so what happens when you get a round done, especially a bigger round like that, you're going to get preference shares, almost 100%, and they're going to have preference terms. And within those preference terms, most of those terms, or all of them, are to protect that investor, not to
yeah,
protect you. So what are some of those preference terms that can happen? And the thing is, the higher the valuation you want, the more preference terms you get
yeah,
normally. Because
absolutely.
the investors are like, fine, you can have the high val, but if you don't get there, I want this and this and this and this and this and this, which
Yeah,
normally
you
just
need to be
really
able to work out what's in it for the founding team. If I'm taking a late stage check and I've got a two times preference, a two times liquidation preference. What does that mean in English? What does that mean mathematically? And it's usually about outcome. And if you can't get an exit, you've worked all these years, and there's been lots of examples. I mean, I've spoken to a founder last week that is a very close friend of mine, around what happens to people that raise money. They get large checks and they can't deliver, and if they, it's almost like a signaling thing to say, I want one times, two times. I'd rather someone say, I don't want to invest if I'm not going to back the founder. So being able to come back and say, look, let's try and stick to a vanilla process, and not try and get oversubscribed, and not just take what
yeah.
you need to get to the next level. And but
Well,
you
that's the
can't do
great
that.
insight.
You
If
can't
you got
do
it
that
in,
unless you've worked it out and modeled it. And then
hmm.
I've sat in accelerators where people have said, don't do a financial model. That's, I go, holy shit, why are you saying that? This is you need to know what the bets are going to be, and where to make them, and what your model is, and what works. And a revenue model with a goal of achieving that and being able to deliver on those promises. How the hell can you do that without any of those tools? The best companies in the US have used these. Why are we thinking we don't need them? There's
Hmm.
CFOs of finance directors of Facebook or Meta, and I've spoken to them, and that's what they do. Like it's good enough for us too.
No, totally. And it's a red flag. I mean, if you're getting a term sheet that has, liquidation preference multiples in it, or anything negative, and just ask your lawyer or accountant or trusted advisor, like, is there some punitive stuff in here? And that's probably just an indication that the company's not quite there or the valuation's not quite there. And so there's ways to adjust. There's other investors you can talk to. There's different levers you can pull to have a cleaner cap table, to have a cleaner preference stack, to keep your company growing in a nice and balanced way. and to minimize risk a little bit. And there's enough risk in startups as it is without creating cap table risk as well. So yeah,
Yeah,
great
and
insight there.
managing your investors, like, don't invest if you don't back me. Like, come on.
100%.
Yeah,
The
there's
best
and
the best founders and investors, they just have ordinary shares. I love seeing that. It's not always possible, but I really, really love seeing those rounds getting done.
well, I think the problem is a bit of misinformation, and if you go back to where safes are from, it's like, Y Combinator, and they were investing in 100 startups. So how can they possibly agree what a valuation is for 100? So they just said, here's an
Mm.
easy way of saying, look, let's just apply a uniform approach. That doesn't mean you have to use a safe note to raise money. If you're good enough to raise money on a certain figure, and it's going to be the most expensive raise at the start, but that post money safe note is like a ticking time bomb of how much you raise based on the formula of what your your cap is, and if you are taking more and more money, you are getting more. If the founder's taking more and more money, the founder is the one getting diluted, and it's a very favourable term for investors. A post money safe note. And by the time you've got more
The
investing in options and etc., it's the founder who's the actual one that's losing sleep at night. And there's often, and I think I heard you say Bill Tresfell's on here. There's a good mate of mine. He says that a lot of VCs get a disproportionate value to what the founder gets, and I completely endorse what Bill says in that comment. And that's because they negotiate. This is what they do for a living. And there's some great VCs out there. Don't get me wrong, but you can't just say this is a job for the lawyers to do or the accountants to do. You need to get better at understanding, what money you're taking and what it means, and what you're going to spend it on, and how you're going to add value to customers to get to the milestones faster, so that you can prove that you're a good steward of capital. And between cash, culture, and customers, that's your job, the CEO.
Let's move on a little bit to minimizing dilutions. How can you guys, like, okay, we all realize we want to minimize dilution. What's some ways we can do that? We talked about like negotiating harder, talked about like minimizing rounds and just controlling the way you do the funding. Some other ways to do it. So bootstrapping is kind of obvious. A lot of people, when they say they're bootstrapping, they're self-funding. So that's like a little bit different. It's like, hey, I've got $10 million and I'm putting $1 million in my startup and I'm bootstrapping. So let's differentiate. So bootstrap is like doing it yourself. Just, a bit of sweat equity, just like doing anything you can, no code, low code, just basically just like hacking through things as best you possibly can. That's sort of how I would describe bootstrapping. You can do a little bit of funding in there, so it doesn't mean you can't fund a bit yourself, do a little bit of friends and family. Like I think all those sorts of things fit in there. It's just basically spending as little money as possible and diluting your cap table like as little as possible as is bootstrapping. So, lean on your friends, lean on your family, lean on smart people, organize hackathons, like just any crazy shit you can come up with to have your product and go to market progressing without costing you any money or equity. Or absolutely as little as possible. So definitely do that. Like if you can bootstrap through pre-seed, I reckon it's one of the biggest and best things you can do. Like if you can get
Yeah,
more
and Jess, one of
revenue.
the one of the smart people listening just made a comment I just saw pop up talking about
Mm,
maybe sales, getting some sales to
100%.
help extend your runway. And
Yep.
obviously trying to find product market fit, but again, looking at the right type of sales. Like you can go and become a consulting company and have maybe distraction from that, but it's still being all in on the that value proposition and the ideal customer, ideally. While you bootstrap and do proof of concepts, and while you're explaining it to
Yeah, totally.
your investors
Just do
about
any.
how you become a better capital steward.
Yeah, absolutely. Investors will say, hey, like you can't have services revenue or this or that. But if you can use that to keep your business afloat,
Mm,
build your product and get it to market without having to do a pre-seed round,
mm,
then you're in great shape when you go to get that seed round done. You got real revenue,
absolutely.
you got more
Absolutely.
data, all that stuff. So These ones I've put here from my experience. They're not like super obvious. Maybe they are, maybe they aren't. But like this next one is about the time value of money, you know? So people sometimes say, oh, like I can't afford this SaaS or I can't afford this person, or and I'm not saying you should be blowing your money either, but just bear in mind every month that goes by when you're burning is extremely costly. So you need to be learning super, super fast. You need to be moving really, really quickly. This is, you know, perhaps a little bit less when you're bootstrapping, but definitely once you've got money, raising money, and you're really burning, you know, 30, 50, 100K a month, it's extremely costly, just time. So just bearing in mind, you need to be hitting your milestones really, really quickly. Um, you know, just factor in that everything takes twice as long and is twice as hard as you think. So don't set yourself up incorrectly to fail on that basis as well. We've talked about this before, being super strong with your terms and your valuation. So do your research, you know, get your financials done, go out strongly to get the best possible valuation and the best possible terms, have the right advisors, have the right lawyer, you know, get all that stuff right. It does help a lot with your dilution management. Having an amazing team with no waste. So, you know, quite often people have too big a team. There's a little bit less now because it's a super tight cash and you know funding environment. So it's a little bit less relevant now, but just keeping your team as small as possible. When you raise a round, don't just go out and hire like you know a bunch of people. Be really really careful with who you hire. You know, the best team I'd be thinking is like product manager, engineer, designer, marketing, you know, and the smallest version of that that you can have, the better. Obviously, the founder's got to be one or two of those roles as well. So ideally, you want to go all the way through to revenue and revenue growth with a tiny little team of, you know, 2 to 4 people, if you can. And then the last one, you know, being fast to the scalable channels. This is a lesson that I've seen many startups have to learn the hard way, including us. You know, you're always doing founder sales initially, and you're always doing that grind initially. But the quicker you can go from, say, founder sales to those really scalable marketing and sales channels, the better. So from day zero, you know, and from day one, trying to quickly get, you know, like a scalable and repeatable go-to-market motion is going to save you so much of your equity. It's the difference between having, you know, like a seed and a Series A and then having, you know, extra rounds in the middle, or you're trying to work out how you can get to 10, 20, 30 million in ARR and you know what channels and what's the go-to-market motion going to be and how does it scale through you know through that phase. The quicker you can learn that, the quicker you can articulate that and be confident in allocating capital, um, the higher the valuation you're going to get, the less rounds you're going to need to raise, and the more accurately you're going to be able to allocate that capital, which is super value accretive for all your shareholders.
Your market testing, you're shipping your product, you're discovering what's resonating. You might, you're overlaying your taste and design and your skills to work out, is this adding more and more value to customers? And that's, you don't want to be leaving too long between those experiments. So getting that into that motion, as you called it, um, you know, you get more swings at the plate, more learnings, more better iteration. And also, people can take forever to do something. Like you want to be, build a high performing team. You are hitting the target. You are collaborating to not miss that deadline.
All right, so when are you going to do a cap table model? So if you're preparing for a round, of course, you're saying, hey, what happens after this round? What happens after a couple of rounds? If you've got safes and notes, you've got to think, well, how much equity are they going to convert in? Or are we going to do another safe round before we do like a share round? So you really need to be modeling out. This is probably the most important time when you're modeling out your cap table. You're looking at all those variables that we talked about before. You've got valuation, you've got how much you raise. You've got safes and notes, pre-money, post-money. You have to be on top of this stuff. Each of those things can cause 10, 20% additional dilution. Sometimes you might make 2 or 3 mistakes in the same round. Of course, we don't want that for you, but just bearing in mind, it's super important to be strong on these things leading into a capital raise. Yeah, then when you're assessing offers, you might get multiple offers for a round with different terms. and different valuations and different amounts. So you need to
So
be able
different
to
behaviours
compare
too,
those
Jason.
things.
Like different behaviours from investors, different bench strength that they can add, different doors they can open, different. Are they leaning in, boots on the ground? Are they hands off, letting you do it? Are they, you might take a lower valuation from a better investor. So there's all these things. They're nuanced solutions to. There's as I said, you can't follow formulas. You got to play the people. You got to play the team. You got to get better at capital allocation, launching products
Mm,
regularly, testing, learning, um,
mm.
building out
So
your
you need someone
metrics.
smart on your team that can run all those scenarios. So a good commercial or legal partner that can help you understand the practical implications of the different benefits that the investors bring. And then you need somebody financial that can show you all the different cap table models so you can compare the financial element to, to the qualitative elements. It's quite complicated, but just absolutely invest the time in putting your best foot forward there. And then Dave, I know, one of our both of our big bugbears is just understanding the impacts of convertible, securities like notes and safes. It's very easy to raise too much money on notes and safes and not understand how much impact that can have when it comes to dilution.
Yeah, and I think the other thing is that I'd add a six as well to that, Jason, have a who. Like, who do you want on your cap table? Like, who behaves well, who adds value, who's supportive, who's, an absolute punish, who, holds you back, who's the bottleneck, um, who
Yep.
who who makes you take enough risk without being stupid, who helps you make better bets. Like, there's just so many good investors in Australia.
So
Uh,
do your DD, do
that
your
doesn't mean
DD,
they're all
ask
good
around.
investors. That doesn't
Mm.
mean they're all good investors. There's so many
Bef-
sad stories out there from taking money from the wrong people. But there's some great investors out there, and like, we know some of those people.
Yeah, it's painful. Conversion modeling we talked about with safes and notes. Round modeling we talked about. We haven't talked too much about employee option modeling. If we get time, we're going to talk about that in a minute. And then exit waterfalls. So, once you sort of seed Series A, you start to think about what happens at exit. If I've got a preference stack, preference A, preference B, preference C, sometimes as you go through the rounds, how does that work? Will the founders and employees end up with any money? How much risk is there that we're going to end up with nothing, even if we have a pretty good outcome? So you need to be able to, once you get to like that early to middle stage, you need to be starting to think, well, what preference terms, how big a preference stack can I handle? What's the right amount of risk for this company, so that we can make sure that in a high, medium, low outcome, everybody has some level of success, and you're always trying to take off like the worst case scenario of the people that did the really hard work for the first 4 or 5 years ending up with nothing, that kind of thing as well. So that exit waterfalls are really, really important for understanding all those outcomes.
Yeah, and also just to add on that, there's some things that people may not have seen or heard of, but I've seen scenarios where VCs have said, "I want the founder to get more shares." So there's potential to have either premium priced options because they've already got 10%, or they've got loan plan shares, or they've got other ways of getting equity to top them up, so they've got enough skin in the game, which sort of protects them against these preference and liquidation preferences and other dilutions that have happened. But also the other thing too is take note in what building a good relationship with these investors is. That they might start with having a a fairly bad cap table in terms of dilution, but look at the IPO of Atlassian. They took some of their shares and they converted them to B class, and those B class shares had a 10-to-1 voting entitlement. Now, you don't get to do that if you haven't done a good job. You don't get to do that if you haven't formed a good relationship with the employees that now own shares, and so you have that transparency and being able to tell people how we're going, where we're going, and what we're doing, and why it's working, and what we've learned, and how we're going to get better at those things. Those things matter, and being able to be reasonably proficient with managing your capital and explaining this to people allows you that almost second chance to go out and say, all right, okay, I'm below, 30% or whatever, or 10% or whatever the founders of some of these, very successful companies are, but I still have, you know, at 17%, I still have 51% of the voting rights, for example.
Yeah, love that. And while we're talking about like recapitalization, which sort of I feel like that fits into that. So based on the stakeholder needs and the various requirements of the company, players can be added equity throughout the journey. The classes can be changed, to put the company in the best possible position, which is best for everyone. And on that vein, so Abby has asked, what are the cap table options, Dave? You can start this and I can, jam on a little bit. So just for example, what happens if the original founder split becomes a bit imbalanced?
Mhm.
How can we help resolve that over time?
Well, firstly, one of the slides that people put up about founders getting equity is they go, 50-50 sounds fair. And I go, well, first point is there's no such thing as fair. And the second part is that, people can, I've worked with founders that have said, no, we don't need this. And one's raised money and the other one's pissed off to Bali surfing, uh, or Germany or wherever. And they've, um, so that mechanism where you could look at it as an anti-investor or anti-founder, but you could also look at it as a co-founder protection mechanism as well. Because if you're going into this and you're saying, I'm going to hang around till the end, but you don't have to, I feel like that does put that into perspective, that you think that is a fair type of dilution. If you're not going to hang around, yes, you've helped create the value, but you might have some early vesting, etc. If you knock the lights out, for example. But those are reasonable things to think about, in my opinion.
Yeah, for sure. So, the first thing is try and have a more balanced think about it in the beginning. It doesn't have to be 50-50. I think you probably start there, but then you make adjustments based on, effort, strategic input, capital raise, all those things. And you might end up with something more like 60-40, 70-30, whatever. It's good to do that thinking on day one. You want to have a vesting agreement. If you haven't got one, you can always put one in place. Founders normally have like a 3 or 4 year vesting period, and it's important because for whatever reason, founders might stop doing their role, and then at
Well,
least you
cake,
can
cake
take
handles all of that, Jason. I'm going to just
cake
say
handles
it.
cake handles all this. Um, pretty
This
much
doesn't have to
everything
be.
we've
This
talked
does not
about.
have to be difficult.
Pretty much everything we've talked about, you can automate with Cake. Just to get a quick plug in there. We've been working on that nonstop for 6 years, so do check it out. And then you can recapitalize. Sometimes it goes well, sometimes it doesn't. And then sometimes you need lawyers and sometimes you can't do anything and then you just have to deal with it. But anyway, you can renegotiate. Normally around a capital raise or a major event when there's a lot of pressure is a good time to try and, take advantage of these things. So look, for those of you that are very new to cap table modeling, I'm just going to run through the absolute basics in this example. If you've got questions, start firing them in because we'll look to favor the questions in the last 5 minutes. So please do fire them in, but we've tackled all the questions so far, so that's great. So in absolute basic terms, here we have at the top and under the assumptions, we have a $6 million company, so 6 million pre-money, and there's 2.5 million shares. So it's a 2.4, $2.40 share price. The angel's putting in 2 million, so it's 8 million post. So you can see that for your newbies, like pre-money means before the money and post-money means after the money, and the only difference is the money. So that's a good lesson for you today if you're new. If that's all you learned, that's valuable enough. I'm sure it's not, but there you go. And then to go into the details down below, you can see that the founders, there's three of them. They had, 2.5 million shares between the three of them. And then you got the new investment. If you're going across to the right-hand side, you've got the five new investors coming in with their $5 amounts. They're each getting new shares, right? So when you do a share round, you're creating new shares. So you're not like transferring or doing anything weird. You're creating new shares. And you can see that those new shares equal, individually, around 5% each. And you can see up the founders have gone from 40% to 30% or 15, 20% to 50%. So it created new shares. In total, we still have 100% and the founders have been diluted. to give you
Can
another.
can I just add
Mm.
a point to even simplify it even more? Well, I like to explain because people say, what's the difference? Well, you give people a formula, and they say, well, pre-money valuation is this and a post-money is that. So think of it this way. You think your company is worth $6 million. And the investor says, yes. And you go, oh, great. They agree. But then they say, we agree it's worth $6 million, post our money and post an option plan of 10%. Now, let's say they're putting in 600,000 and now they want a 6%, sorry, 10% option plan. That just made your company worth, hypothetically, 20% less. So just think about it in those terms. It's as simple as that. And the more money you take on a post money safe note, the more diluted the founder becomes. Now, that doesn't mean you might be getting a whole slice of watermelon because you've done such a great job with using that money. It's not inherently bad or good post money. It's just understand the differences and use that potentially to say, okay, you think standard is post money, so let's talk about the valuation because I'm happy with a post money note, but I am not happy with that valuation now. So this is where the conversation and being able to say this is like getting good and conversant with this and working out how do you explain your company and why you're different and how you're going to nail this and nail the equity and nail the capital allocation. These are the nuances, if you like, that will set you apart from the other investors. So other offers or other people that will potentially take that investor's money. So this is why it's important. So I want people just to understand
No,
why you need to understand this better than you maybe currently do.
because any mistake you make could cost you 20% of your company. And if you do that a few times, you're in deep shit.
Absolutely.
It costs
Deep
you
shit.
millions and millions and millions and millions down the track and control of your company just because of small errors. So we're not here to scare you. It can be done. You just need the right advisors and the right advice, and you need to invest in understanding it. And you'll still make mistakes, but we just want to minimize those mistakes
I'm sure a lot of
as
people knew
much as
that,
we
but I just
can.
wanted to dumb
Some
it down.
people don't know it for sure, absolutely, and I think it's well worth explaining. So this is the next example, just to just to think it through a little bit. Some people have never seen this before. The only difference here is that this company has an ESOP, right? So you've still got 6 million pre-money, you're still raising 2 million, there's still 8 million post-money. But you can see in this example, we've got 4 employees with some equity. In total, they've got 13.3%. And so you can see if we compare. In this instance, John Smith, the top founder, has 26%, and in the first instance, they had 30%. So just seeing how much dilution just having an ESOP provides, that's the only change. And then look, slightly more complicated example. This is with 2 rounds. So this is now up to an $18 million pre-money valuation. They're taking on 5 million in new capital, so it's 23 million post. And you can see the structure of this, and each round, the structure would normally be the same. So you've got the very first round, which has the founders and the team, and then you got the first lot of investment coming in, which was the 2 million, and now you have the next lot of investment coming in, which is the 5 million. So again, you're creating new shares, and in this instance, we're just using shares, but it could be safes or notes, and in this case, you'd have to deal with those variables. But in this simple example, what we're trying to show you is that each new investment coming in, they get a certain number of shares based on the share price, and then those new shares dilute the previous investors or employees or anyone that was there previously. They all get diluted equally. It's possible that you would have an anti-dilution clause. They're very rare, but if there is, one type of investor or one investor has anti-dilution, you have to bear that in mind. But under normal circumstances, everybody would be diluted equally. And then just really quickly, at each round you just, ideally the pre-money valuation increases, the amount you raise increases, but the structure sort of stays the same. New shares get added, new investors, and dilution of everybody equally, that was there previously.
We're all
So
in
we've
this together.
run we've run out of time. We're all in this together. Exactly. We've run out of time. I didn't quite stick to the 30, 40 minutes, but there was a lot to cover and we did some questions along the way. There's tons, years and years and years of research, heaps of rounds and millions of dollars raised, of experience there for you. We really hope that we helped you, mitigate some risk, get this stuff right. If you want help with this, do come and see either of us. If we can't help you, we definitely know who can, and we know the right people that can sort of just hit the nail on the head for you. So, yeah, again, thanks for joining us. Very glad you joined, and hope we helped.
Yeah, thanks very much, Jason. Thanks, everyone. It was a lot of fun, and hopefully, it was an interesting amount of information to get on something that's somewhat complicated sometimes. Anyway, have fun, enjoy the rest of your day, and keep building your companies.
Yeah, good luck at that. Cool. See yous. Bye.